Good afternoon, ladies and gentlemen. Today we're going to take a look at the financials for Guzman and Gomez. This stock is going to IPO tomorrow, which is Thursday, the 20th of June, 2024 at 12 p.m. Now, this stock is hotly talked about both on social media, which is getting quite a bit of memes, and in things like AFR and just other newspaper articles talking about this IPO, just kind of pumping it up a little bit. Now, the expectation across the board is that this should open somewhere in the ballpark of $22 per share. And if that's where it opens up, that's a market capitalization of about $2.2 billion. So let's take a look at what $2.2 billion gets you for an IPO on ASX. We have revenues going from financial year 22 to 23, an increase of 50%, which is a great start to the sound of a growth story. And then we have another 30% increase in revenue for the next financial year, and then we have about 26% for the year after that in the forecasts. However, as delicious as those numbers are, we scroll down and we see the EBITDA. That's another way of saying operational profitability. We take out all the expenses of running the business. We have about $29 million EBITDA. And then you dig a little bit further, and you end up with a net profit of $3 million, which has gone backwards from the previous year, despite rising 50% in EBITDA, in revenue, sorry. So the numbers are interesting. They're definitely interesting. And we go a little bit further, and we're going to see in the next report, financial report that's going to come out, I suspect very soon, is 3.4 million. So a modest increase of 400K on net profit after tax. Now, I assume these guys are expanding, and that's kind of the whole talk about this company, this stock, is the expansion rate and all that sort of good stuff. But, you know, you got to spend money to make money. But ultimately, we're looking at the numbers, and I mean, you're paying $2.2 billion, assuming it opens at $22. Now, I'm not a financial advisor. I'm not recommending you to buy, sell, or do anything, but I am asking the question for anyone that's looking at investing in this stock is why? For $2.2 billion in market cap, you're getting $30 million in EBITDA and $3 million in net profit after tax. $2.2 billion is the market cap. We take a look at their competitor, CKF, or Collins Foods Limited, which owns KFC. This is their half-year report. Not the full year like Guzman and Gomez. This is the half-year report. And look at the stark differences between the numbers. We have a rise in revenue. Actually, all the metrics are here, you can see, but let's just take a look at the key numbers we just looked at for GYG. NPAT, $31 million. Net profit after tax, this is 10 times higher than Guzman and Gomez now, and it's a half-year report. One could look at this and perhaps double it to get an estimate of the full year report. So you're looking at roughly 60 million for the financial year, 20 times more than Guzman and Gomez. Now, here's the kicker. This company's worth half of GYG. Assuming GYG opens at $22 at 2.2 billion market cap, this company that owns KFC is worth $1 billion. And it has 20 times the net profit. We look at the EBITDA, which is rising. We're going to assume it's going to be roughly $200 million, as opposed to the EBITDA of $43 million, right? 5 times the EBITDA. So my question is, why would someone pay double the market cap and get a fifth of the product in terms of financials? We look at CKF, which is the daily chart on the ASX here. We can see the valuation here sitting at about $1 billion. It's kind of gone sideways for the most part. It's kind of ranged between, you know, this sort of $8 and $12 range for quite some time, especially since COVID for the last 4 years. So as a stock, it's a little bit ho-hum. The financials in the prior year were actually not that good. So the full year report, they did have a big slump. As we can see here, it sort of got punished for it. Big slump. And they kind of just recovered because eventually the stock would just pick back up, which is why you can see the numbers in the half year were looking so good. And ultimately, I think the difference between GYG and CKF is GYG has the growth and expansion story. I saw a chart the other day where it showed how rapidly GYG was opening stores, and it was looking at overtaking KFC stores in terms of quantity, and it was all just forecasting stuff. But ultimately, the story for GYG is the expansion. But at the moment, the financials are built. Sorry, not the financials, but the price of the IPO at $22 or higher is pricing in perfection. And we're talking absolute perfection, growth perfection, expansion perfection. It's, in my eyes, it's probably too much risk for the market cap that it's getting. And you got a competitor here. Now, KFC and I guess CKF generally, they're probably not expanding. You're not seeing many new KFC stores. You're probably seeing a little bit of stagnation there, which is probably what you're seeing reflected in the stock price, which is probably why they're paying dividends. It's kind of going sideways, paying a bit of dividends, and they're just trying to compete in the fast food market, and they're probably, as you can see here, just being a little bit stagnant. But still, I personally would probably prefer this pivot point here at around $9 to buy than to buy GYG. Now, that's not suggesting GYG is going to open at 22 and everyone's going to see it as overvalued and sell off. I'm not making predictions on the IPO price. The first few months are going to be price discovery. For all we know, GYG can open at $25, crash down to 20, then move to 30, and who the fuck knows what goes on with GYG after IPO price. But I thought I'd give you guys just a quick look at the financials and ask yourself, what the fuck are people doing buying this stock? I don't know.